Welcome back to the deep dive. Today, our mission is, well, it's pretty laser focused, but the subject. It's immense. We are tackling one of the biggest, most complex, and frankly, most puzzling players in North American energy. That's Energy Transfer LP, ticker ET.
Yeah, this isn't just a deep dive. It's more like an excavation, really. Because ET isn't your typical corporation. It's set up as a master limited partnership in MLP, and its asset base is just staggering.
Staggering is the right word.
We really need to cut through all the layers here. You've got the unique tax structure, these colossal, super ambitious growth plans. I call it the barbell strategy. And I think most importantly, this persistent question. Why does the market always seem to discount its value compared to pretty much all its major peers?
That valuation puzzle, that's really the key, isn't it? Because we're talking about a true giant here. Just for context, if you look across the energy infrastructure landscape, ET is one of North America's largest, most diversified midstream companies. I mean, number 53 on the 2025 Fortune 500 list. That kind of scale, that economic footprint, it's just huge.
And to put that into like physical terms, just try to picture the sheer scope of their network. They operate roughly 140,000 miles of pipelines, plus all the associated infrastructure. It spans 44 states.
Wow, 140,000 miles.
It's an unparalleled coast-to-coast footprint. Took decades, billions and billions of dollars to assemble. And look, this isn't just about moving crude oil. They're moving natural gas liquids, NGLs, refined products, basically across the entire country.
Okay, so that leads us right to the foundational question we really need to tackle for you today. How does a company with this just incredible physical scale manage to generate cash flow that's so predictable, so resilient, and why does its sheer complexity, both administrative and structurally, create this, persistent drag on its market price? Let's try to unpack this business model first.
Right. To really get a handle on ET, you first have to understand the midstream sector itself. Energy Transfer is that essential critical link in the whole North American energy value chain. They're not the drillers. Okay, and they're not the refineries at the end.
They're the middleman.
Exactly. They provide the services, transportation, processing, storage. They get hydrocarbons from those major U.S. supply basins like the Permian or the Marcellus right to where they're desperately needed. Both domestically and internationally, they export to over 80 countries.
So they're basically the toll road operators for energy molecules. And that scale we talked about, the 140,000 miles, that's their strategic weapon, right? It's their foundation.
It absolutely is. And that infrastructure, think about it, it's almost impossible to replicate today. You've got the regulatory environment, all the permitting hurdles, just the sheer capital required.
Forget about it.
Once it's built, it provides this sort of protective moat around their business. It's incredibly valuable.
And that infrastructure, that moat, it leads directly to the core of their business, doesn't it? That fee-based revenue anchor.
Yes, precisely. The stability, the resilience of ET's cash flow, it doesn't come from them taking speculative bets on the price of oil or gas. No, it comes from long-term contracted commitments they have with their customers.
Okay, so how much are we talking?
Management estimates that for 2025, roughly 90% of their projected adjusted EBITDA, and that's really the core measure of their profitability we need to watch, 90% is expected to come from these predictable fee-based arrangements.
90%? That's massive stability. It means they have extremely limited sensitivity to commodity prices, doesn't it? The sources seem to confirm this, saying only about, 5 to 10% direct exposure?
That's correct. If natural gas prices suddenly get cut in half tomorrow, their contract fees, they don't change. They still get paid the same amount per unit moved.
Okay, so that sounds almost too good to be true. Where's the catch?
Well, that's the textbook definition.
Yeah.
Right? But this is where the nuance is absolutely critical. This is the aha moment, I think. When you analyze these midstream companies, while they are insulated from price volatility,
right,
they are definitely not immune to volume risk. You've always got to keep an eye on the long-term health of the upstream producers, the drillers.
Okay, tell us more about that volume risk. How does that work? How quickly does that lag effect usually hit their results, maybe based on past downturns?
Well, if you look really closely at these long-term contracts, they're typically structured on a per-unit basis.
Yeah.
So X dollars per barrel transported, or maybe Y cents per million BTU processed.
Okay.
Now, if you get a sustained, really severe downturn in the industry, and that forces the upstream producers, the drillers, to significantly cut back their activity. They drill fewer wells, right? Okay. Production slows down.
Naturally.
Then, the volume of crude or gas or NGLs flowing through ET's system eventually starts to decrease. It's not immediate. We generally see this impact lag the actual price downturn by anywhere from, say, 6 to 18 months. It takes time as the existing drilling commitments wind down, and crucially, new projects just fail to materialize.
So if the Permian Basin, for example, saw a major sustained production cut, it wouldn't hurt ET's bottom line tomorrow, but maybe a year and a half down the road, they definitely feel it in their throughput and their fee revenue. It's like a delayed exposure, not zero exposure. That makes perfect sense.
Exactly, you nailed it. They are fundamentally a leveraged play on North American production volumes, not directly on commodity pricing. That's the key distinction.
Okay. Now let's circle back to complexity again, because that massive stable cash flow we're talking about, it's generated across 5 huge complementary business segments, which, while stable in aggregate, must make modeling ET incredibly challenging. You're basically analyzing 5 different companies under one roof.
It is challenging, but that diversification is also the true genius of their structure, in a way. It acts as a natural hedge against risks that might pop up in a specific region or a specific segment. And if you look at the Q2 2025 adjusted EBITDA contributions, these segments are actually surprisingly balanced. That really enhances the overall stability.
So what's the breakdown look like?
The largest segment, currently around 27% of EBITDA, is NGL and refined products, natural gas liquids, and things like gasoline, diesel.
And that's where you find some of their real crown jewels, isn't it? Like their massive NGL fractionation and storage complex down at Mont Belvieu, Texas. That thing's one of the largest in the world.
It absolutely is.
And it includes those really critical export terminals too, right? Marcus Hook up in Pennsylvania and Nederland down in Texas. They can export huge amounts, something like 1.4 million barrels a day of NGLs, mostly propane and butane, out to global market.
Precisely. And that ability to export NGLs, that's a major strategic differentiator for them. Then, after NGLs, you have the classic midstream segment. That's the gathering pipelines pulling from the wellhead and the processing plants contributing about 20%.
Okay.
Crude oil transportation, which includes capacity for around 7 million barrels per day, that accounts for another 19%.
And the big long-haul gas pipes, the natural gas inter- and interstate segment, that's also 19%. That seems very balanced.
It is. That's the system responsible for moving huge amounts of natural gas over long distances, capacity for something like 32.4 million MMBtu per day, an enormous underground storage capacity, 236 billion cubic feet. That storage is absolutely invaluable, especially during peak demand periods or, major weather events like hurricanes.
Yeah, that storage is key for reliability.
Definitely. And then finally, the remaining 15% comes from their equity interests in other publicly traded partnerships, most notably Sunoco LP, the gas stations, and USA Compression Partners, which provides compression services.
So you can see how that diversification works. If the crude oil segment maybe hits some turbulence, say, temporary pipeline usage drops the strength in NGL exports, which might be fueled by strong global demand, acts as a shock absorber.
That's the real power of their integrated diversification. You're capturing fees basically from the moment the product leaves the wellhead through all the processing, transportation, right up to the point it gets exported or hits a domestic power plant.
But integrating 5 massive operations like that and having analysts and you as an investor needing to model each one separately, that is precisely why many investors, especially the big institutional funds that really prefer simplicity, find that persistent valuation discount almost understandable.
The complexity itself is a bit of a deterrent, isn't it?
It absolutely contributes, no question.
Speaking of complexity, let's dive into the structure itself. Energy Transfer is organized as a Master Limited Partnership, or MLP. And this is what separates it entirely from a standard C corporation, like, say, an ExxonMobil or a Chevron. And it's the source of both, great tax advantages and some pretty significant administrative headaches for the people who own it, the unit holders.
Right, the MLP structure, legally it's a partnership, not a corporation. That's the critical point. You've got the general partner, or GP, which actually runs the day-to-day operations, makes the decisions. And then you have the limited partners, the LPs, who are essentially the public unit holders providing the capital.
Like shareholders, but legally different. Exactly. And the defining and often fantastic feature is that it's a pass-through entity for tax purposes. This means the partnership itself does not pay federal income tax. Instead, all the income, the deductions, the credits, they pass directly through to you, the unit holder, to report on your personal tax return.
Okay, so that pass-through nature means less tax paid at the corporate, or rather, partnership level, which should theoretically mean more cash available for distributions to investors, right?
That's the theory, yes. Higher potential distributions.
Yeah.
But to get those benefits, you have to deal with the administrative gatekeeper, the dreaded K-1 form.
Ah, yes, the K-1, not the simple 1099 DIV you get for regular stock dividends.
Not at all. The Schedule K-1 is this complex, multi-page document. It details your specific allocated share of the partnership's financial results for the year, your share of the income, the expenses, the depreciation, tax credits, all of it.
And they always seem to arrive late, don't they?
They often arrive much later than standard 1099s, sometimes forcing investors to file for tax extensions. For many people, honestly, just this administrative burden and the fact that you might need specialized tax preparation software or help, that alone is enough to keep them away from investing in MLPs.
But that K-1 complexity comes hand in hand with a powerful tax advantage that MLPs really rely on. That's the concept of return of capital, or ROCE.
Yes, absolutely. Because MLPs like ET own these vast networks of physical, capital-intensive asset, all those pipelines, processing plants we talked about, they generate huge non-cash deductions on their tax returns. The biggest one by far is depreciation.
Yeah.
This enormous depreciation expense significantly reduces their reported net taxable income. Often the actual cash they distribute to investors is more than their taxable income for the year. That difference, the portion of the distribution that exceeds taxable income, is classified as a return of capital.
And that ROCE is what makes it so appealing to income investors because that part of the cash distribution is tax deferred, right? You don't pay tax on it immediately.
Precisely. It is not taxed in the year you receive it. Instead, it acts as a reduction of your cost basis in the investment. So let's say you buy 1 unit of ET for $10, and in the first year you receive $1 in cash distributions, and let's say $0.80, that is classified as ROCE.
Okay.
Your cost basis in that unit immediately drops from $10 down to $9.20. You are essentially deferring the tax liability on that $1.80 portion of the distribution until the day you eventually sell your units. For investors who are really focused on current tax-advantaged income, this can be a massive benefit.
But as they always say, the tax man eventually gets his due, sometimes with interest, it feels like. The complexity really seems to ramp up when you finally decide to sell your units, maybe after holding them for years and accumulating all that ROCE. What happens then?
Yeah, that's the critical detail that often gets overlooked by new MLP investors. It can be a bit of a shock if you're not prepared. When you sell, the tax process is sort of twofold. First, all that cumulative return of capital you received over the years, the amounts that kept reducing your cost basis, that amount gets recaptured. Meaning it's taxed as ordinary income in the year you sell. And ordinary income tax rates can often be higher than capital gains rates.
Ouch. Okay, so that's part one.
That's part one. Then, second, any remaining gain you realize above your original purchase price. So, in our example, anything above the initial $10, that part, is then typically taxed at the prevailing capital gains rates.
Oh.
So this combination of ordinary income recapture plus potential capital gains upon sale, it can lead to a large, complex, and potentially quite surprising tax bill. It requires meticulous record-keeping over the entire life of your investment to track that declining cost basis.
It really sounds like a deferred tax bomb, and just the complexity of calculating that multi-year cumulative cost basis. I can see why that's a huge reason the valuation discount exists. People just don't want the hassle.
It's a major factor.
Yeah.
And we absolutely must issue the standard warning here for anyone even thinking about holding MLPs like ET inside a tax-exempt retirement account like an IRA or a 401k.
Like the UBTI trap.
Absolutely. This is the landmine that even sophisticated investors sometimes miss. You think, oh, I'm safe, it's in my IRA, no taxes. But MLPs, because they are partnerships legally, can generate something called unrelated business taxable income, or UBTI.
And what's the problem with UBTI?
If your tax-exempt account generates more than the annual threshold, which is currently $1,000 of UBTI from all sources, including MLPs, then that UBTI income suddenly becomes subject to taxation, even inside the IRA. It effectively negates the tax benefit of holding that investment in that specific type of account.
So holding MLPs in an IRA can actually create a tax liability.
It can, if the UBTI exceeds that $1,000 threshold. For large institutional investors or even individuals with substantial positions in MLPs within their retirement accounts, this potential UBTI issue makes MLPs inherently non-starters for those specific tax-sheltered accounts. It just adds another layer of complexity and potential cost. Hashtag TechTech3, the midstream industry landscape and growth catalysts.
Okay, so moving beyond the structural complexity for a moment, let's look at the broader industry landscape. The general outlook for the midstream sector in 2025 is, well, it's generally characterized as neutral to modestly positive. It seems underpinned by pretty strong fundamentals across the board.
Meaning what exactly?
Meaning high cash flow generation pretty much sector-wide, and a real commitment you're seeing from management teams to growing distributions and returning capital to shareholders or unit holders. Discipline seems to be the word of the day. But ET isn't just sort of surviving in this environment. They seem positioned to really capitalize on two incredibly powerful and frankly almost historically unique tailwinds right now. This is what we were calling the dual demand pull, right? And it seems to be the main justification for their really aggressive growth strategy over the next decade.
That's exactly right. The first tailwind, and historically the most significant one we've watched for years, is the booming global demand for U.S. liquefied natural gas, or LNG.
Right, shipping natural gas overseas.
Yeah. Global LNG demand is projected to grow dramatically. Some forecasts say by as much as 60% by 2040. This is being driven by nations, particularly in Asia and Europe, looking to transition away from coal for power generation and also seeking greater energy security and supply stability.
And that requires...
It requires a massive build-out of new, high-pressure, large-diameter pipelines to move all that natural gas from the supply basins, the Permian in West Texas, the Marcellus in Appalachia, the Haynesville in Louisiana, down to the Gulf Coast, where these multi-billion-dollar LNG export facilities are being built or expanded.
Okay, so that's the big global export story. It's powerful, though, potentially cyclical, depending on global economics. But the second tailwind, that's the one that's really burst onto the scene just in the last couple of years, hasn't it? It seems to have energized the entire market, the AI and data center catalyst.
It really has. It's this new, rapidly emerging domestic demand vector. The exponential growth in artificial intelligence and the data centers needed to power it is consuming just unprecedented amounts of electricity.
Unbelievable amounts.
And because grid reliability is absolutely paramount for these data centers, they cannot afford downtime. They require enormous amounts of stable, dispatchable power that's there when you need it, 247. And right now, that means a significant resurgence in the development of new natural gas-fired power plants.
Because renewables alone can't guarantee that level of reliability yet.
Not at the scale and consistency needed for these massive data centers. So this AI boon is creating a direct domestic demand pull for the exact transportation and storage services that ET provides. And often, this demand is much closer to their existing infrastructure footprint.
It really sounds like they're hitting a demand sweet spot, almost perfectly positioned. But of course, nothing is ever easy in this business. The giant shadow hanging over every single one of these big, new greenfield growth projects is that regulatory headache, right?
That is absolutely the primary headwind facing the entire sector right now. Regulatory and permitting risk. Building new, large-scale interstate pipelines, the ones that cross state lines, faces intense legal challenges, vocal environmental opposition, and just protracted, complex regulatory scrutiny at both the federal and state levels.
And the result?
It leads directly to long delays, sometimes years,
Yeah.
significant cost overruns that can blow project budgets, and sometimes, sadly for the developers, outright project cancellations after years of effort and millions spent. Building new major energy infrastructure is incredibly hard right now.
And that difficulty, that risk and delay in building new pipes is directly fueling the massive M&A trend we've seen across the midstream space, isn't it? With ET really leading the charge.
Correct. It's much easier, faster, and often less risky to buy than to build. Since building new is so fraught with risk and takes so long, consolidation, mergers, and acquisitions has become the preferred growth strategy for many. Companies like ET acquire existing midstream systems to instantly gain scale, enter new geographic basins, bolt on complementary assets, and enhance efficiency, all without facing that 5 to 10-year delay and the legal risks associated with major new construction.
We also can't completely forget that regional commodity volatility still matters, right? Even with that strong fee-based model. Things like the negative natural gas pricing we sometimes see at the Waha hub out in Permian Basin. That highlights that pipeline takeaway capacity is still a constraint in some areas.
Absolutely. Those regional price dislocations are a symptom of infrastructure bottlenecks. And if prices stay extremely low or even negative in those constrained regions for too long, producers will simply have no economic choice but to reduce drilling and shut in production. And eventually, ET feels that volume pain we talked about earlier. It underscores the volume risk.
So when we benchmark ET against its major peers, companies like Enterprise Products Partners, EPD, Kinder Morgan, KMI, maybe Williams, WMB, how does ET stack up competitively?
Well, ET's sheer scale really stands out as a core competitive advantage. That 140,000 miles of pipe. It's substantially larger than, for instance, Kinder Morgan's system, which is around 79,000 miles.
Yeah.
In the pipeline business, scale definitely matters. It provides operational flexibility and efficiency.
Okay, so beyond just being bigger, if you were to distill their key competitive edge down, what would you say it is?
I'd say it's the unmatched integration of their assets. Because they own pipes and facilities stretching across so many states, covering so many different product types, crude, gas, NGLs, they can often capture fees at multiple points along the value chain, from the wellhead gathering system, through processing plants, down long-haul transmission lines, maybe into storage, and then finally out to an export terminal or a domestic power plant customer.
Like a one-stop shop?
In many ways, yes. This integration gives them a synergistic advantage, greater operational efficiencies, and just unparalleled optionality compared to smaller, less diversified players. They are arguably perfectly positioned to benefit from that dual demand pull. We keep mentioning the global LNG waves and the domestic AI power surge in a way that maybe a competitor focused only on natural gas transport or only on NGL exports simply cannot match. They can play in all those sandboxes simultaneously.
Okay, let's delve into exactly how they're trying to translate those powerful tailwinds, LNG and AI power, into actual growth on the ground. The core of their strategy, as you mentioned earlier, is what they call the barbell approach. Can you explain that? It sounds like heavy M&A on one end.
That's right. Heavy M&A focused on acquisitions for immediate scale and cash flow is one end of the barbell, and they are absolutely the sector's main consolidator right now. The most recent and really transformative M&A example was that $7.1 billion all-equity acquisition of Crestwood Equity Partners. That closed in November 2023.
And that wasn't just about getting bigger for bigger's sake, was it?
No, not at all. It was highly strategic. It significantly deepened ET's presence in the critical Williston Basin up north and the Delaware Subbasin within the Permian. And importantly, it gave them a strategic foothold in the emerging Powder River Basin in Wyoming. Plus, the deal was structured to be immediately accretive to their distributable cash flow per unit, which investors liked.
And they supplement those huge blockbuster deals with smaller, more targeted bolt-on acquisitions too, right?
Yes, they do. We saw that with the acquisition of Lotus Midstream in 2023 and then WTG Midstream more recently in 2024. These deals weren't just random purchases. They specifically enhanced their gathering, processing, and transportation capabilities right in the heart of the Permian Basin, which, remember, is the absolute engine of all U.S. hydrocarbon production growth. So the M&A strategy is very focused on achieving growth relatively quickly without taking on the immense risk of building brand new interstate pipelines from scratch.
Okay, so that's the M&A end of the barbell, buying existing assets. What about the other end, the organic growth side?
Now, for the organic side of that barbell, this is where the big bets on the future lie. At the long cycle, high potential, maybe even moonshot end, you have the Lake Charles LNG project in Louisiana.
Ah, yes, the big LNG export facility.
This isn't just a simple upgrade. It's a colossal undertaking. They plan to convert an existing, underutilized LNG import terminal into a massive LNG export facility capable of producing around 16.5 million metric tons per annum. If this gets completed, it would be an absolute game changer for ET's business mix and long-term cash flow profile.
Huge potential.
Yeah.
But the sources we looked at indicate this mega project is already facing some significant headwinds. This seems to highlight the execution risk that's inherent in this whole barbell strategy. What's the biggest single hurdle right now to getting that Lake Charles facility actually built and online?
Yeah, it's facing challenges. The main issues right now are cost and the timeline. While they have achieved a major milestone by signing the engineering, procurement, and construction EPC contract, that's a huge positive step, it locks in a contractor. The project is running into industry-wide issues. Things like significant cost inflation, especially for specialized labor and critical materials like steel, and ongoing supply chain constraints for complex equipment.
And that's caused delays.
It has. These pressures have unfortunately caused delays. The crucial final investment decision, or FID, that's the definitive financial green light from the company, to actually start spending the big bucks on construction that's been pushed back. It was originally targeted for late 2025. Now it's expected sometime in the first quarter of 2026.
So a real-world demonstration that these massive projects are incredibly difficult to execute perfectly on time and on budget, especially in the current environment.
Absolutely. It underscores the execution risk. However, on the commercial side, they're making good progress in de-risking the project financially. They've already signed long-term sale and purchase agreements, or SPAs, with major players like Chevron to take large volumes of LNG.
That helps guarantee revenue.
Definitely. And crucially, they also signed a framework agreement with MidOcean Energy. MidOcean is planning to take a substantial 30% equity stake directly in the Lake Charles LNG project itself. Having major strategic partners like MidOcean sharing the multi-billion-dollar capital burden and also committing to take LNG volumes, that really helps offset some of that timing and execution risk.
Okay, so Lake Charles is the big long-term swing for the fences. Now let's look at the other end of that organic barbell, the projects designed to deliver cash flow much sooner with more certainty.
Right, the shorter cycle certainty projects, these are focused almost purely on capitalizing on that Permian production growth and the growing domestic power demand, especially from data centers. A prime example is the Desert Southwest Pipeline project.
Tell us about that one.
That's a major domestic expansion project. They're planned to build about 516 miles of new pipeline capable of moving 1.5 billion cubic feet per day of natural gas. And it's designed specifically to transport that gas out of the constrained Permian Basin westward into power-hungry markets in Arizona and potentially Southern California, maybe New Mexico, too.
Yeah.
This directly addresses that immediate domestic power generation surge we discussed earlier.
So connecting Permian supply directly to Western power demand makes sense. What else is in that near-term pipeline?
We also see them moving forward with the Hugh Brinson pipeline. This provides new interstate capacity, meaning within Texas, also moving gas out of the Permian. Phase 1 of that is already under construction, and they've already reached a positive final investment decision, or FID, on Phase 2. So that's moving ahead.
And NGLs, that's always been their bread and butter.
Absolutely. They continue to steadily expand their NGL infrastructure, which consistently generates high returns. They're building new cryogenic processing plants in the Permian plants, with names like Badger, Lenora II, and Mustang Draw. And they also recently sanctioned construction of their 9th NGL fractionator down at the massive Mont Belvieu complex. Fractionators are what separate the raw NGL stream into usable products like propane, butane, ethane.
So these are like smaller, high-certainty, high-return projects that keep the cash flow engine humming along while the giant Lake Charles project gestates over the next few years.
That's exactly the idea. The overall analysis of this barbell strategy is that they're trying to do two things at once. They're pursuing potentially transformative decade-long growth with the big LNG bet, while simultaneously funding a steady pipeline of numerous smaller, quicker payback projects, mainly focused on the Permian and that power generation demand. That should guarantee strong cash flow growth in the near term, say the next 2-4 years.
It sounds exceptionally aggressive, though. High risk, high reward. It must require immense capital discipline to pull off both ends of that barbell simultaneously.
It really does. They have committed to a colossal $5.0 billion growth capital expenditure plan just for 2025. That's a huge number. This entire strategy only succeeds if that capital is deployed flawlessly, minimizing delays and cost overruns like the one we just saw starting to creep into the Lake Charles timeline. Execution is absolutely paramount.
Let's elaborate a bit more on that AI opportunity, because it sounds like management sees this demand surge as almost a gold rush. The numbers they're citing seem surprisingly tangible, not just hypothetical.
They really are. Management has stated publicly that they are currently evaluating opportunities related to connecting their pipelines to approximately 200 different data centers spread across 15 states within their existing asset footprint.
200 data centers.
That's the number they're looking at.
Yeah.
And the concentration is incredible. In Texas alone, they're apparently evaluating requests for about 150 potential data center connections. So, you see, this isn't just theoretical demand based on broad market projections. Those are specific requests coming in for connection and service agreements.
Can you paint a quick picture of what that physical connection process actually looks like? Is it usually just a quick, simple bolt-on connection, or does it involve major new pipeline construction?
It really varies depending on the location. If a new data center complex happens to be sited very close to one of ET's existing mainline pipelines, it might be a relatively simpler last-mile bolt-on, maybe just a few miles of smaller diameter pipe. But often, especially for the really large hyperscale data centers, it requires more significant short-haul pipeline expansions or loops to connect their main transmission system to a brand new gas-fired power plant that's being built specifically to serve that data center's massive electricity needs.
So they're connecting to the power plants that feed the data centers?
Often, yes. And they've said they're actively executing agreements right now, particularly with utilities in the Midwest, to connect their existing gas pipelines directly to these new gas-fired power plants being built specifically to serve this exponential data center load. So this unique dual catalyst, the pull from global LNG demand and the push from domestic AI power demand, that confluence is the core justification for their massive $5 billion capex budget today. They see a window of opportunity, hashtags fee, financial performance, and capital management. All right, let's shift gears and look at their financial performance. When we review their financials, say from 2019 through 2023, the first thing that really jumps out at you is the dramatic volatility in their top-line revenue number.
Yeah, it seems all over the place.
It really does. It peaked way up near $90 billion back in 2022 when commodity prices were sky high, before moderating back down to around $78.6 billion in 2023 as prices cooled off.
The core profitability metrics, they tell a much steadier, much more reassuring story, don't they? Which seems to reinforce the effectiveness of that fee-based business model we discussed.
Absolutely. The underlying profitability is much more stable. Adjusted EBITDA, which again is the best measure of their operating fee revenue, actually grew quite consistently through that period. It went from $10.3 billion back in 2019 up to $12.7 billion in 2023.
A steady climb.
And distributable cash flow, or DCF, which is basically the cash flow available for funding growth projects and paying distributions to unit holders, that followed the exact same stable upward trend. Very consistent growth in the underlying cash generation.
And crucially, we see that significant divergence between their GAAP net income and that distributable cash flow number, right?
Yes, that's very typical for MLPs and important to understand. In 2023, for example, their DCF was a very robust $7.6 billion, but the reported GAAP net income was only about $4.75 billion, a big gap.
And that difference, that gap, is primarily explained by this massive non-cash depreciation charges we talked about earlier, related to their huge asset base, correct?
It's exactly right. For this kind of capital-intensive industry, DCF is by far the more meaningful metric to focus on. It represents the actual cash coming in the door that's available to fund growth and pay those distributions. You really have to look past the GAAP net income number in this sector. It can be misleading due to depreciation.
Okay, let's maybe clarify a point that I think confuses a lot of listeners watching the quarterly results. There seems to be this recurring pattern in recent quarters where ET's headline revenue number keeps missing the Wall Street analyst forecasts, even though their profitability metrics like EBITDA and DCF come in strong. Can you maybe use an analogy to clarify what that pass-through cost of the commodity really means in layman's terms and why those revenue misses might not matter as much?
Certainly. It's a great point. Think of Energy Transfer like a giant freight trucking company. Their main business is charging you a fixed fee, say $1,000, to transport your cargo from point A to point B.
Okay, a fixed transport fee.
Right. Now, that freight company's reported revenue on its income statement might actually include two things: the $1,000 fixed fee they earn, plus the cost of the diesel fuel they had to buy for the truck to make the trip, which they just pass along directly to you, the customer, on the invoice.
Ah, so the fuel cost is a pass-through.
Exactly. Now, what happens if the price of diesel fuel, the commodity, suddenly drops by 50%? The freight company's headline total revenue that they report will drop dramatically because that pass-through fuel cost component is much lower.
But their profit didn't change.
Precisely. Their actual profit on the job, their EBITDA or their distributable cash flow, which comes from that fixed $1,000 delivery fee, stays exactly the same, or maybe even improves slightly if they hedge fuel costs well.
So the market, or at least the sophisticated analysts, correctly ignores those top-line revenue misses caused by falling commodity prices and focuses entirely on the strong adjusted EBITDA and, importantly, the underlying volume numbers being transported. Those are the true indicators of the health of the core fee-generating business.
That's exactly right. You focus on the fees and the volumes. And those underlying volumes are strong for ET right now. In the first quarter of 2025, for example, their adjusted EBITDA grew a healthy 6% year-over-year to $4.1 billion, beating expectations. And in the second quarter, despite maybe some noise in the revenue line due to commodity price fluctuations, they actually set new partnership records for volumes transported in several key areas. Midstream gathering, crude oil transportation, and NGL exports were all at record levels.
So that underlying operational strength seems to justify their financial guidance for the rest of the year.
It does. And based on that continued operational strength, the partnership has recently reiterated very high guidance for the full year 2025. They're projecting adjusted EBITDA to land somewhere between $16.1 billion and $16.5 billion. And they're maintaining that ambitious $5 billion growth capital expenditure budget we discussed.
Okay, $5 billion is a lot to spend. That brings us to their capital allocation strategy. It sounds like a real balancing act they have to perform.
It absolutely is. They have three clear, and sometimes competing priorities
Yeah.
that management has to manage simultaneously. First, they need to fully fund that high-return growth CapEx program, the $5.0 billion. Second, they're committed to continuing to strengthen their balance sheet, paying down debt. And third, they want to continue growing their distributions to unit holders.
How are they doing on the balance sheet front? That used to be a concern for ET.
Their commitment to balance sheet strength has really paid off recently. They've been successfully managing their leverage down. They're currently operating in the lower half of their own target range, which is 4.0x to 4.5x net debt to EBITDA. And perhaps most importantly, they achieved a critical milestone recently by securing investment-grade credit ratings BBB from both S&P and Fitch.
That's huge. Why
Yeah.
is investment grade so important?
Getting that investment grade rating is
Yeah.
a significant de-risking achievement, especially for a company like ET that was historically associated with more aggressive leverage levels during its high-growth M&A phase. It lowers their borrowing costs, broadens their access to capital markets, and just provides a stamp of financial stability that reassures investors.
And that stability then allows them to follow through on the third priority, returning cash to unit holders.
Exactly. With the balance sheet in a stronger position, they feel comfortable targeting 3 to 5% annual distribution growth. And they demonstrated that commitment by increasing the quarterly distribution again early in 2025, up to 0.3325 per unit.
We should also probably mention maintenance capital, right? Keeping that huge system running isn't free.
That's a vital point. It's not just about growth CapEx. Maintaining their massive 140,000-mile system requires significant ongoing spending just to keep everything safe and operational. That's called maintenance capital expenditure. For 2025, they're projecting that to be around $1.1 billion. And critically, they have to fund that maintenance CapEx out of their distributable cash flow before they can pay out any distributions or fund new growth projects. So DCF needs to cover maintenance first. Hashtag C6, valuation, risks, and governance.
All right, now we finally arrive back at the great puzzle that we started with, the valuation. For a company this large, generating seemingly stable fee-based cash flows with such integrated assets, why does Energy Transfer consistently trade at a significant discount compared to its main peers and even compared to its own historical average valuation?
Yeah, it's the multi-billion-dollar question for ET investors. And to analyze it properly, we really need to use the appropriate valuation metric here, which for MLPs and infrastructure companies is enterprise value to EBITDA, or EV to EBITDA.
Why that metric instead of, say, a price-to-earnings ratio?
Because EBITDA strips out the impact of debt levels, which enterprise value accounts for, and crucially, it ignores all those huge non-cash depreciation and amortization charges. They can really distort the PE ratio for asset-heavy companies like ET. EBITDA gives you a clear look at the underlying operating value relative to operating cash flow.
Okay, so using EBITDA, how stark is the discount for ET?
It is stark, and it's undeniable when you look at the data. ET's trailing 12-month EBITDA multiple is currently running at approximately 8.0 times.
8 times. How does that compare?
Well, compare that first to ET's own historical average valuation, which has been closer to 11.6x over the long term, so it's well below its own history. Then compare it to key, well-regarded competitors in the space. Enterprise Products Partners, EPD, typically trades around 10.3x EBITDA. Kinder Morgan, KMI, which is a C Corp but a major peer, often trades near 12.9x.
Wow, so 8.0x versus 10.3x or 12.9x. ET is clearly trading cheap on a pure metrics basis relative to the competition.
Undeniably cheap on the numbers.
So why? Why is the market so wary? If the cash flow is reasonably stable, the volumes are setting records, and the assets are premier, what are the main reasons, maybe the top 4, that analysts consistently cite for this persistent valuation discount? What's the market worried about?
The market seems to harbor some deep, lingering reservations about ET. I'd say the 4 primary reasons usually cited are: first, the inherent complexity of the MLP structure itself, which, as we discussed, narrows the potential investor base due to the K-1 hassles, the Rovesi tax treatment upon sale, and those UBTI risks for retirement accounts. Fewer natural buyers means less demand for the units.
Okay, complexity is number 1. What's second?
Second is the company's history, particularly its history of very aggressive, sometimes debt-fueled M&A activity and occasionally complicated financial policies in the past. This has created concerns about integration risk. Can they successfully digest these large acquisitions? And maybe some lingering distrust among investors who felt burned by past actions.
Right, the legacy of past deals. Third,
and this is a big one, perceived corporate governance concerns, specifically related to the significant ongoing influence of the company's founder and current executive chairman, Kelsey Warren.
Okay, let's pause on that governance issue for a second because it seems absolutely central to the discount thesis for many analysts. Now, we know that management and insiders own a huge chunk, like 13% of the common units. They clearly have skin in the game. They put their money where their mouth is, buying over $411 million worth of units personally between 2021 and 2023. So if they're so aligned with unit holders financially, why does the market seem to distrust that alignment? Or why is the governance concern still so influential in suppressing the unit price?
That's a great question. It really boils down to the difference between financial alignment and effective control. While that high insider ownership is definitely a positive, ensuring a strong long-term focus, the market perceives that the high concentration of power and strategic vision around the founder executive chairman can lead to rapid, very aggressive strategic shifts, like embarking on massive, potentially risky acquisitions or capital projects that might prioritize long-term empire building and scale over maybe short-term stability or hitting quarterly earnings targets perfectly, which Wall Street typically favors more.
So it's seen as a double-edged sword.
Exactly. Highly aligned on long-term value creation, yes, but perhaps also potentially resistant to changing course or moderating ambition when maybe a more conservative approach might seem prudent to outside investors. It creates a perception of higher potential volatility in strategy.
Okay, that makes sense. And the fourth major reason for the discount.
The fourth reason is simply the sheer execution risk associated with that massive, ambitious $5.0 billion annual CapEx program right now. If a cornerstone project like Lake Charles LNG gets significantly delayed or goes way over budget, that just reinforces the market's fears and likely causes that valuation gap to widen even further. They have to prove they can deliver on these huge promises.
So putting it all together, the investment thesis for ET today is essentially a bet that the company will successfully execute this massive growth strategy, continue to strengthen its balance sheet, keep growing distributions, and ultimately convince the market that those historic concerns about governance complexity and M&A integration are truly in the past, not the future.
That's a perfect summary of the bull case. You're betting on future execution overcoming past perceptions.
And the question of potentially converting from an MLP to a simpler C corporation structure, which would eliminate the K1, get rid of UBTI issues, and potentially open the door wide to institutional investment, that seems key to potentially closing that valuation gap long term.
Right. It is often seen as the ultimate potential catalyst for unlocking value at ET. If they converted to a C Corp, they'd likely see their valuation multiple expand significantly almost overnight, just by attracting a broader investor base. Management has acknowledged that conversion is an option they continue to evaluate regularly.
But no immediate plans.
But they've also stressed it is not an immediate plan. There are significant tax consequences to manage in a conversion. So for now, investors have to accept that the complexity of the MLT structure remains the trade-off for getting that beneficial tax path through treatment on distributions.
Okay. Finally, let's just wrap up with a quick comprehensive risk assessment. Beyond the big execution failures on projects, what other risks should investors keep in mind?
Well, the primary strategic risk, as we've hammered home, remains the failure to execute those large, complex capital projects like Lake Charles or Desert Southwest on time and, critically, on budget. The recent FID delay at Lake Charles is a perfect, real-time example of this risk manifesting.
Okay, execution risk is number one. What about operational risks?
Beyond strategy, they face significant operational risks just inherent to running thousands of miles of physical infrastructure. You have exposure to potential pipeline failures or accidents, which can have devastating environmental and financial consequences.
And cyber threats, too, presumably.
Absolutely. The threat of cybersecurity breaches on their complex IT and operational technology systems is a growing and constant concern for all critical infrastructure operators. A successful attack could disrupt operations significantly. And we also cannot overlook the immense exposure ET has to extreme weather events, particularly given their large asset concentration along the hurricane-prone Gulf Coast region. Major storms can knock critical facilities offline for extended periods and require massive repair costs.
That Gulf Coast concentration is definitely a risk factor. And financially, the interest rate environment remains a pervasive concern for everyone, right?
It does. If we remain in a higher-for-longer interest rate environment, it significantly increases the cost of financing that huge $5.0 billion annual CapEx program, as well as the cost of refinancing their existing debt as it matures. Higher borrowing costs put constant pressure on their ability to maintain that delicate capital allocation balance. We talk about balancing growth spending, distribution increases, and continued debt reduction. It just makes everything tighter financially. #outro.
Wow, we have covered a tremendous amount of ground today on Energy Transfer, really tried to cut through layers of operational and structural complexity. To summarize it all, it feels like the company's story really rests on two giant intersecting pillars right now. First, there's its unmatched scale and that core fee-based financial stability, which is derived from that incredible 140,000-mile integrated infrastructure network and the fact that roughly 90% of its earnings come from those predictable fees.
That's pillar one, scale and stability. And pillar two is its incredibly aggressive barbell growth strategy. It's trying to uniquely leverage that immense asset base to capture growth from two massive concurrent demand drivers, the enormous global demand for U.S. LNG exports and that rapidly accelerating domestic need for more natural gas to power the massive AI and data center boom.
So the big picture takeaway seems to be that the success of this immense, complex enterprise hinges almost entirely on the timely, disciplined, on-budget delivery of its major organic growth projects, things like Lake Charles LNG, the Desert Southwest Pipeline, and all those ongoing Permian expansions. That execution is what justifies the immense capital spend they're undertaking, and frankly, that execution is what the market is clearly waiting to see proof of.
They absolutely have the assets, they have the underlying cash flow generation, and they certainly have the demand catalyst lining up. The final crucial hurdle is demonstrating flawless execution in what remains a very challenging regulatory, inflationary, and operational environment.
And that leads us directly to our final provocative thought for you, the listener, to mull over. We've established pretty clearly that the persistent valuation discount applied to Energy Transfer stems, in large part from its high structural complexity as an MLP, and also from the market's historical caution regarding its governance and its aggressive growth strategy. Now, the question is, if the company successfully manages to leverage this current unique dual catalyst, this confluence of new LNG demand and AI-driven power demand, and if they actually prove they can execute on a $5 billion a year capex plan effectively, will the market finally overcome its historical skepticism and reward ET's unparalleled scale and integration? Or is the inherent complexity of the MLP structure, combined with its high control governance model, simply too high a barrier for that significant valuation discount to ever truly close, regardless of operational success?
It really remains a fascinating question of risk versus reward, perception versus reality. Thanks for joining us on this deep dive into energy transfer.
We appreciate you tuning in. We'll catch you next time.